Hi everybody, we are Group 1 and we have done our IPO case on Groupon and it is presented to you by Anahi, Barbara, Dustin, Yvonne, and me, Erica. Hope you enjoy.
So, who is Groupon? Groupon's name blended with group and coupon. Groupon's first deal was a half-price offer for pizzas for the restaurant on the first floor of its building in Chicago. Groupon is a deal of the day website that features discounted gift certificates usable at local or national companies. Groupon was launched in November 2008 and the first market for Groupon was Chicago, followed soon thereafter by Boston, New York City, and Toronto. By October 2010, which is less than 24 months, Groupon served more than 150 markets in North America and 100 markets in Europe, Asia, and South America, and by the time they have at least 35 million registered users. So, what makes Groupon want to go IPO? The whole story starts from October 2010. Yahoo was rumored to have offered over 3 billion to acquire Groupon. On November 30th, 2010, it was reported that Google offered 5.3 billion with a 700 million earnout to acquire Groupon and was rejected on December 3rd, 2010. After the rejection of the Google buyout offer, Groupon proceeded with their own initial public offering. On December 29, 2010, Groupon's executive board approved a change to Groupon's certificate of incorporation that would permit the company to raise $950 million in venture capital funding, based on the valuation of $6.4 billion company worth. On June 2, 2011, Groupon failed to go public under the ticker symbol of GRPN. The IPO was handled by Morgan Stanley, Goldman Sachs Group, and the Credit Suisse Group. Go public and list their shares for trading on stock exchanges for a number of reasons, but the most common are the need for capital for the firm and need for liquidity for initial investors. As the firm grows and requires more capital to fund its operations and expansion, financing through internal sources and private investors become difficult and costly. Through a public offering of stock, a firm can tap into a larger pool of capital, which may enable it to raise additional funds at a lower cost and than through other sources. In Groupon's Form X1, they discloses that it plans to use the proceeds from its IPO for working capital and other general corporate purposes, which may include the acquisition of other business, products, or technologies. Another motivation to go public is to offer early investors as well as employees an opportunity to realize their gain on their investment and employee stock options. Ever since January 2011, Groupon has been actively acquiring other sites like Mercado, a social shopping service based on the Facebook platform, and Breadcrumb, a point-of-sale system and iPad app that targets local restaurants.
I'll be talking about some of the major contents of Groupon's S-1 filing. An S-1 is a legal document filed by public companies to register their securities with the U.S. Securities and Exchange Commission. It commonly includes a description of the company's business, financial statements, biographies of officers and directors, detailed information about their compensation, any litigation that has taken place, and a summary of material information. It is one of the main documents used by investors to research a company prior to an initial public offering. S-1s contain standard information required by the SEC. They are typically very long and tedious to read. Groupon's 263-page S-1 was amended 8 times since its first filing. The filing starts off with an introduction letter by Andrew Mason, Groupon's CEO at the time. It is succinct, informative, and funny, and is written in a way that gives a sense of their culture, corporate values, and personality. It is followed by a cover page which includes information about the registration of the equity security, including ticker symbol, class of offering, size of the offering, and expected price. Then the prospectus summary, which gives us a brief summary of the company and the rest of their S1 contents. Another section of the S1 points out risk factors that Groupon wants its investors to consider. They state, "We have experienced rapid growth over a short period in a new market that we have created, and we do not know whether this market will continue to develop or whether it can be maintained. If we are unable to successfully respond to changes in the market, our business could be harmed." Groupon provides a long list of factors that they believe will affect whether they maintain their historical rate of revenue growth. Groupon's selected consolidated financial and other data section gives revenue performance, margins, profitability, and cash flows. This is where Groupon took a fair amount of heat for its use of a non-GAAP financial measure called the Adjusted Consolidated Segment Operating Income. They removed this measure in the second filing, but then needed to amend a third time to restate its revenue. With this amended filing, Groupon separated out gross billings from net revenue. Previously, they called gross billings just revenue. This section also showed that Groupon had a loss of income from operations for the years ended December 31st, 2008, 2009, 2010, and the first quarter of 2011. In its business section of the S1, Groupon provides colorful screenshots of its website and gets the readers better acquainted with the company. They show what products and services were offered and how that ties into their revenue model. Here, Groupon answered questions about its business model and provided insight into subscriber and geographic economics. Next, Anna will go into some specific highlights of Groupon's S1 filing.
Thanks, Barbara. I will be discussing a few topics under Groupon's financial statements and notes. The first is their basis of presentation. Their consolidated financial statements include the accounts of the company and its subsidiaries. The company's consolidated financial statements were prepared in accordance with U.S. GAAP and include the assets, liabilities, revenues, and expenses of all wholly owned subsidiaries and majority-owned subsidiaries over which the company exercises control. Under the topic of stock splits, we see that in May 2010, the company's board of directors approved a resolution to effect a 3-for-1 stock split of the company's common stock with no corresponding change to the par value. The stock split became effective in August 2010. The board also approved a 2-for-1 stock split of the company's common stock in December 2010 with no corresponding change in par value, which became effective in January 2011. When it comes to cash and cash equivalents, the company considers all highly liquid investments with an original maturity of 3 months or less from the date of purchase to be cash equivalents. Accounts receivable primarily represents the net cash due from the company's credit card and other payment processors for cleared transactions. The carrying amount of the company's receivables is reduced by an allowance for doubtful accounts that reflects management's best estimate of amounts that will not be collected. The allowance is based on historical loss experience and any specific risks identified in collection matters. Accounts receivable are charged off against the allowance for doubtful accounts when it is determined that the receivable is uncollectible. Property and equipment includes assets such as furniture and fixtures, leasehold improvements, computer hardware, and office and telephone equipment. The company accounts for property and equipment at cost less accumulated depreciation and amortization. Depreciation expense is recorded on a straight-line basis over the estimated useful lives of the assets. The company recognizes revenue from Groupons when the following criteria are met. Persuasive evidence of an arrangement exists, delivery has occurred, the selling price is fixed or determinable, and collectivity is reasonably assured. Groupon has an interesting MD&A process. It measures their business with several financial and operating metrics. They use these metrics to assess the progress of their business, make decisions on where to allocate capital, time, and technology investments, and assess the longer-time performance of their marketplace. Under financial metrics, Groupon first displays information about gross profit. Gross profit is the amount that Groupon retains after paying their merchants an agreed-upon percentage of the purchase price to the featured merchant. Gross profit is an important indicator for their business because it is a reflection of the value of their service to their merchants. Groupon has an adjusted consolidated segment operating income. Adjusted CSOI is operating income of their two segments, North America and International, adjusted to add back online marketing expense, acquisition-related costs, and stock-based compensation expense. Additionally, Groupon describes that their free cash flow is cash flow from operations less amounts paid for purchase of property and equipment. Cash flow is an important indicator of their business because it measures the amount of cash they generate after spending on marketing, wages and benefits, capital expenditures, and other items. Later on in the presentation, Erica will further discuss CSOI and free cash flow. Under operating metrics, Groupon has information about their subscribers, customers, and Groupon sold. Subscribers are the total number of individuals that have completely registered through a specific date, less individuals who have unsubscribed. They can measure their overall growth in the market as well as their potential revenue opportunity as a function of their total subscriber base. Cumulative customers are the total number of unique customers that have purchased Groupons from January 1, 2009 through a specific date. The metric is an important indicator of their business performance as it helps them understand the purchase rate of their subscribers. Groupons sold is a metric which measures the total number of Groupons sold in a given time period. This metric is presented net of Groupons refunded during the same time period and measures their growth and activity level in the aggregate as well as in the individual markets. There are two important factors affecting performance. The first is subscriber acquisition costs. They must continue to acquire and retain subscribers who purchase Groupons in order to increase revenue and achieve profitability. The second is competitive pressure. Their growth and geographical expansion have drawn a significant amount of attention to their business model. As a result, a substantial number of groups buying sites that attempt to replicate their business model have emerged around the world. In addition to such competitors, Groupon expects to increasingly compete against other large internet and technology-based businesses such as Facebook, Google, and Microsoft, each of which has launched initiatives which are directly competitive to their business. Now Dustin will talk about the SEC's comments and responses.
Thank you for the introduction. In the next few slides, I will be talking to you about SEC comments, major subsequent amendments, Groupon's roadshow, and the underwriters that were involved in the Groupon IPO. The SEC comments were not in short supply regarding Groupon's Form S-1 filing. One comment that the SEC made was regarding co-founder Mr. Lakovsky's statement in an interview about Groupon being wildly profitable. In response, Groupon had to add a risk factor cautioning prospective investors not to rely on any information other than the prospectus in making their investment decisions. The SEC also made a comment regarding revenue recognition prior to delivery of the underlying product or service by the merchant to the customer. Groupon responded by stating that the relevant transaction is the purchase of the Groupon itself, not the purchase of the underlying good or service. The company advised the SEC that once the Groupon has been electronically delivered to the customer, the criteria for revenue recognition has been met. That is, persuasive evidence of an arrangement exists, the arrangement fee is fixed or determinable, delivery has occurred, and collectability is reasonably assured. The SEC also made a comment regarding the Groupon promise and the implications of it being a guaranteed refund and why Groupon believes the amount of future refunds is reasonably estimated. Groupon then responded stating that company policies to defer revenue recognition for the amount of the purchase price refunds expected to be ultimately granted at the time of the transaction. However, shortly following Groupon's IPO, refunds for big-ticket items such as laser eye surgery were determined underestimated and the impact of the company's financial statements greatly. One major amendment was that the SEC required Groupon to adjust its revenue recognition and restate its revenues and gross profit. While the restatement had no substantial impact on the company's bottom line, the restatement essentially meant that Groupon's revenue were cut in half overnight. Because fast-growing technology and internet companies, especially companies that are experiencing losses, as was Groupon, are often valued as a multiple of their revenues, this sharp decrease in the revenue number had the potential to significantly affect Groupon's possible valuation by investors. The issue related to Groupon's use of adjusted consolidated segment operating income that Erica will be discussing later on in the presentation. Another major amendment was regarding the CEO, Mr. Mason's email that he sent out to company employees. In the email, he talked about the ridiculous speculation that Groupon was a risky business destined for the slaughterhouse. He also discussed some financial metrics and trends to explain why Groupon was in good shape. The SEC was very concerned about this email because at the time Groupon had already filed its IPO paperwork with the SEC, and once that occurs, neither the company nor its executives can do anything interpreted as increasing investors' appetite for the IPO within a certain time period. Groupon's lawyers were then asked to provide legal rationale and detail as to why Mr. Mason's email didn't violate SEC rules. Also, so that investors could understand the full context of Mr. Mason's email, Groupon was required to include an unedited copy of the email as Appendix A. As many of you are aware, the roadshow is a big part of the IPO process. It is where company executives travel around pitching their company as a great investment opportunity to various investors. Groupon was initially set to start its roadshow in September of 2011. However, Groupon decided to delay the roadshow, stating the purpose being stock market volatility. Others, however, speculated that it was not due to market volatility, but instead due to the bad press that the company had been receiving. Groupon's executives had a tough journey ahead of them in pitching their company's stock to potential investors. There were many critics out there that didn't believe that Groupon was a good investment. Many critics focused on Groupon's massive losses. Groupon was yet to show a profit. Others had questions concerning Groupon's long-term strategy. They didn't know if the high growth rates were sustainable. Marketing spending for the company was also a big issue. Groupon was spending $25 to acquire each customer, which was considered very costly. Another concern was that Groupon was facing heavy competition. Worldwide, there was about 500 sites similar to Groupon, including over 100 sites in the United States. Valuation amongst analysts was very diverse. It ranged from the low end of $3 billion to the high end of $30 billion. This wide range in valuation demonstrates even more the risks that are associated with an investment in Groupon. CEO Andrew Mason and his executive team spent almost 2 weeks on the road pitching Groupon to investors. One of their main focuses was on the new platform for commerce that Groupon offered. Groupon at the time was located in 45 countries throughout the world that represented 90% of the world's GDP. Another point that they addressed was Groupon's great business model. They considered their business model a win for all three parties involved, a win for the customer, a win for the merchant, and a win for Groupon. Another emphasis was on the enormous market potential. They repeatedly stated over and over that this was not a billion-dollar market, but a trillion-dollar market. Other issues that they addressed were the merchant and consumer value that Groupon provided, the business scale that they had developed, different expansion opportunities for Groupon, and the high quality of their executive team. Goldman Sachs, Morgan Stanley, and Credit Suisse USA were initially selected as the three lead underwriters. However, Groupon later added 11 more underwriters for its IPO. Groupon, in its IPO, raised $700 million, at that time becoming the largest IPO by a U.S. internet company since Google that raised $1.7 billion in 2004. Here we have a chart that shows the different companies that participated in the underwriting process of Groupon's IPO. As you can see, Morgan Stanley and Goldman Sachs received the largest portions of the generated fees, $17.4 and $8.9 million respectively. Many companies wanted to be the underwriters of such a popular company like Groupon. For larger companies, IPO underwriting for a particular company is not a large percentage of overall company revenue. Morgan Stanley, for example, in 2011 had total revenues of around $32 billion, and it received only around $17 million in fees from Groupon. However, it does provide the company with publicity and helps them in the process of selling their services to other potential clients that are planning on an IPO in the future. Also, it gives the company bragging rights. Next, you'll be hearing from Erica.
Thanks, Dustin. So I will be discussing some of the issues that were faced by Groupon in their IPO process with regards to accounting, auditing, and disclosures. There are several accounting issues that were faced by Groupon specifically related to their unconventional accounting of non-GAAP financial measures, including adjusted CSOI and free cash flows. Adjusted CSOI is adjusted consolidated segment operating income, which is a metric that measures consolidated income before costs like new subscriber acquisitions and certain non-cash charges such as marketing. In their S1 filing, the SEC did not approve of the metric and responded with, and I quote, "We reiterate our belief that the exclusion of online marketing expenses from your results of operations in your non-GAAP measure is potentially misleading." So they want it to be taken out because it misleads investors, and a little bit later I will be talking about how misleading it is. The other non-GAAP financial measure is free cash flow, which measures the amount of cash generated after spending on marketing, wages and benefits, capital expenditures, and other items. Free cash flow also reflects changes in working capital. The SEC also commented on this measure and directed Groupon to discuss other measures of long-term financial stability that may be calculated differently. On the next slide, I will show you an example of free cash flow and adjusted CSOI. So here is an example of adjusted CSOI and free cash flow from Groupon's initial S1. As you can see, for the year 2011, they have a loss from operations of $117,140, and to adjust for CSOI, they have added back online marketing and stock-based compensation for the year, which turns their loss into a profit of $81,619. As you can see, that's a big change from a loss to a profit. This is exactly what the SEC was referring to as being misleading in their financial statements. So another accounting issue that was faced by Groupon was after they had done their IPO. Less than 5 months after going public, Groupon revised its fourth quarter results. It said it was due to failure of setting aside enough money to cover customer refunds because it honors customer refunds for the life of its coupons, which can affect financials at various times. Refunds are deducted within 60 days from receiving revenue, and after that, the company still has to make additional accounting changes related to the payments. The revision of the fourth quarter results trimmed the revenue by $14.3 million and increased the loss from $42.3 million to $64.9 million. As you can see, that's a big change, and it caused a lot of criticism of the company's accounting process. Accounting issues were not the only problems faced in the IPO process. EY, the independent auditors of Groupon, signed the fourth quarter financial audit report and the annual report giving a clean opinion. Shortly after, statements were revised because EY determined that Groupon had not accurately accounted for the possibility of higher refunds after they had restated their financial statements, which is what I discussed previously. Along with the accounting and auditing issues, there were also some disclosure issues related to the revisions. There was a control weakness present at the time of the company's IPO prospectus. However, Groupon did not have the obligation to disclose the material weakness in the IPO prospectus because SOX has no requirement. SOX only requires the disclosure in its first report, which is what Groupon ultimately did. However, a lot of people were unhappy about the reporting decisions made by Groupon and the lack of EY's obligation to report that weakness. So next, Barbara will be discussing the fluctuations in Groupon's stock price and will give you our overall evaluation of the company.
I'll be talking about Groupon's stock movement. Groupon priced its initial public offering at $20 a share, but actually began trading at $28 a share, an increase of 40%. Groupon floated only a small amount of their shares, 35 million, about 5.5% of its 637.3 million shares outstanding at the time. In just a few months, Groupon's stock price started plummeting. In January of 2012, the stock fell to $17.80 a share. The following month looked a little more promising with prices back up in the low 20s, but this did not last long. In March, the stock started falling again, and it did so steadily over the course of 2012. A year after its IPO, Groupon hit its all-time low to date, $2.78. The stock plunged, but Groupon's share price 86.2% below its initial public offering price and set its market capitalization at about $2 billion. This was one-third of the price that Google reportedly offered in a buyout in late 2010. 2013 was looking much better for Groupon as it had a year high of $12.76 in September. However, over the course of the year, the stock plunged 36% due to poor earnings growth, weak guidance, and rising competition in the local and daily deal space. In the last half of 2014, we're actually seeing the price rise the most it has in more than a year. As of December 1st, 2014, Groupon's shares trade for $7.39. Now I will talk about our group's evaluation of Groupon. Although Groupon was considered the fastest growing company in history back in 2011, it still needed to mature to perfect its core offerings before going public. In November of 2011, Groupon went public and its stock surged from an opening price of $20 per share to over $30 per share in the same day. However, recent earnings reports show that it's actually overpriced. Public shareholders who bought it on the first day have lost nearly $9 billion since opening day. This can be due to the fact that its original business model was easily replicated, and many others such as Living Social and local newspapers from coast to coast went into the daily deal business. What was really driving the company forward was its ever-growing sales force, which had a total headcount of 126 at the start of 2010, but had grown to over 5,000 by April of 2011, not its business model or innovation. The main culprit for such bad performance is that Groupon hasn't been able to generate profits consistently for a long time. What may come as a surprise to its investors is that Groupon has actually grown sales at high rates, even while its stock has crashed. Today, Groupon shares trade at about $7 per share, which is a steep decline from $20 per share when the company first went public. It's also noteworthy to point out that 3 years after its IPO, Groupon is still trying to find a formula for revenue growth and, more importantly, a way to make profit.